Welcome to another edition of BCR Webcasting. Today, I'm very happy to be joined by Igor Zaks. Igor is president of Tenzor Ltd, a consultancy, and Igor will be speaking at our forthcoming Alternative and Receivables Finance Forum, which will take place on the 26th of November at the offices of Clifford Chance in London. Igor, welcome. Igor, your session is about specialty receivables and structured finance, and what do we see next in terms of what's coming up in that area in the coming let's say next year. So I think it's a very interesting topic, and you'll be there on the panel with other panelists, but very keen to get a flavour of your thoughts on some aspects of this in advance of the conference itself. So, what do you think a healthy, well-functioning structured finance ecosystem might look like in 2026, and who do you think will be the key players involved in that?
Okay, so let's look what actually an ecosystem consists of. So what components are there? So we get several parts of it. So if you look at any receivable structure, there is a part of this related to funding. So somebody needs to provide money against, receivables. There is a part related to risk, and there is a part related to management of the system, preventing fraud, connecting, doing transparency, whatever. And there is obviously the fourth component that is very important, is origination, because somebody needs to go to all different parts and get the assets. And if the assets are very bad quality, it's very little other people can do. If assets are better quality, it's obviously much more opportunity to do things. So all four components are very, very important. Sometimes they combine in the same place, sometimes they are split. So if we look at a very historic way, typically there was a factoring company that was doing all of this. And what we get a lot of specialist players that get there. So now we get funding. And funding, the two main sources will be either banks or funds. And there is a lot of funds now that are investing in receivables in one way or another, either as part of the overall strategy or the dedicated strategy. Some of them came under stress recently with all the different things, but generally it's a big area. Then on the risk side, you get credit insurance that been interested in this for a long time and involved in this for a long time. You also get various types of specialist non-traditional players. And then in terms of the platforms, you are getting people who apply all the different tools, and that's basically managing information flows. And obviously you can build various things on top of information flows. And then the last part is origination. And you really, if you need to invest, you need to have a sizable portfolio. So and again, if you just go after, say, one supply, you probably will have a very limited choice. So you need somebody who is able to aggregate and do it. The real question is, do you keep all these functions split? Do you get them combined in one player? Do you have coordination? And again, every way is possible, but it needs to be done properly to be efficient.
Do you see these types of structures, do you see these as a product of more mature markets? I mean, as markets develop and mature and they've been offering, let's say, traditional factoring, invoice discounting, do you see this as a natural progression of markets developing and moving forward to these more complex arrangements of structured finance?
Yes, to an extent it is, because what was the problem with the traditional factoring model? It had a cost of capital implications, because as an independent factor, the access to capital was relatively limited, and it was cost to serve. Because again, with a heavy manual process and relatively low technology, you cannot grow beyond a certain amount without incurring a high cost, and high cost put you in a higher risk portion of a market. So again, in an ideal world with a larger market, you can apply more cost and there are more tools and therefore reducing the cost. You can accumulate something to an interest when you can actually invest in it as an investor. Because again, as an investor, you probably wouldn't do investment in $1 million asset. You would probably need to do it of 50, 100 million as a fund. So you need somebody who is able to aggregate this amount, and you need to get some controls to be able to do it in a good and transparent way. And that's a sign of a more mature market. Uh,
Do you think the returns are sufficient for investors? Because there's been some argument about whether receivables do provide a good return for investors. From what you're saying, I assume that is the case. They are seeing sufficient returns, or will do.
I mean, return is also a function of a risk. I mean, so you are saying whether it provides sufficient return for the risk you are taking. Because if you want to get any type of return, and we definitely seen recent very bad cases when returns looks very high until it's crashed. So so your question is probably whether it create a nice combination of risk and reward. In a well-structured asset, yes, but
I mean, in comparison to other forms of investment where there is a similar kind of risk attached.
Again, the risk of receivable structures very much depends of how they're structured, how transparent they are, what controls are put. With the proper controls and the people know what they're doing, I believe that this asset provides superior and local related returns. Again, if you don't structure it well, you create an illusion. You are getting a high return, it's too good to be true. And that's happened from time to time. But if you structure it correctly and you originate it efficiently, it's a very attractive asset class. You just need to do things properly.
I guess part of the advantages of these more structured approaches is perhaps the cost in terms of things like risk mitigation is reducing as technology and innovation develops and increases. Is that, do you see that? I mean, what are the most what do you see as most promising innovations in terms of managing risk? Whether it's through data analytics or policy structuring or even capital relief mechanisms.
I mean, again, before we talk about analytics, we need to talk about the underlying data, because garbage in, garbage out. So you really need to get a quality data. Then you can apply a lot of tools, and with AI, there are like tons of models. If you have quality data, you can do good things. Now, luckily, we get a lot of technology innovations that improve ability to do the underlying data. One thing that people start using is open banking, because if you see the transactions on a banking level, and you can see it on a buyer, you can see it on supplier. There are tools now that you can get all this data directly from a bank, so you eliminate possibility of a fraud by altering the document. And you compare it with, for example, what you see in the books that you can use open accounting. You compare it with what you see in the physical movement that you can use through logistics system. You reduce ability to do fraud. You also can do much more insights in the credit risk. So again, we can talk about multiple tools you apply on top of this. And obviously we talk about AI, we talk about other things, but availability of the data is a very, very important part. And that's what's going. Now, again, with the fraud, there is tons of new tools, tons of the analytics allowing to deal with the seller fraud, with the buyer fraud, with altering the documents, with all the different things. So again, you apply a lot of technology. In terms of the structures, again, I don't think we are seeing so far many things that are principal difference, but structures are improving because people gain experience, people learning their lessons, people are putting new layers and new parts of the facility structure. So obviously there is a lot of innovation there as well.
So I guess if we're looking forward to 2026 again, we should see this trend increasing in terms of the availability of data, the way that data is analyzed, and how it can be used to manage risk. That's a trend that we're seeing moving upwards, isn't it?
Correct. It's a learning curve. We need
Yeah.
to get investors to start demanding it. We need to start the people in ecosystem accepting it. Do you want to be able to provide this data? If basically everybody is saying you will not finance without it, then you will. What we see in some of the high level, say, fraud cases is you get everybody running to the same supplier, and supplier is dictating what they provide and what they don't, and that shouldn't be the case. And that's going back to origination. If you have a strong flow and you get a lot of people accessing the ecosystem, you are saying that's the rule. Like you want to play it, you play by the rules, and then you get efficient funding, then you get a lot of benefits out of the ecosystem. So we really need to weed up some bad apples, but generally, yes, it's trend.
Mm. But if we were starting from the very beginning and we were looking at how to design um, structured receivables finance programs, is there any way that you would put those together differently to the way they are now? And if you say yes, we should be doing it differently, why we could do that, couldn't we? There's no reason why we couldn't change things.
Yeah. I mean, again, there are multiple things that how it can be redesigned.
Mm.
And again, we can all talk about technology, we can all say about application. I will focus in this particular answer on one other aspect, and the aspect I will focus is insurance. Because today, most of the insurance used there is insuring a non-payment risk of a buyer on compliant receivable. So, and again, it's covering the credit risks that what we see in many cases is not the main risk. Because in many cases, we are dealing with a supplier. And the problems that are happening are related to either supplier performance, so they have a deteriorated quality, they have more disputes, they have different issues, or outright fraud. And again, if we will get insurance products covering these risks, that fundamentally will change the ecosystem. That's not something new. We see it in other industries. So if you look at construction or PPP projects, sure, it is a very
Even to
common,
cover fraud.
yes, even to cover fraud. And again, that's not uncommon. Look at mergers and acquisitions. You have reps and warranty insurance. That was a common product used by insurers in mergers and acquisitions. You tell something, if this is not true, the insurer will actually provide a payoff to the user of this. And we'll go after people who lied. So if somebody is telling in the merger and acquisition, this is the picture of our working capital, or this is the picture of our inventory or our capital investment, and it will happen that this is lie, the insurer, that's exactly what you do with reps and warranties insurers on mergers and acquisitions. Now, if somebody tell me this invoice is fully earned, and it is real, and it is from this company, and there is a statement, the statement may be true or may be lie. Again, I don't see a principal problem for insurers to eventually develop products that stand behind the statement. Of course, it will require due diligence. Of course, it will do things. But same as insurance of a buyer, like you're insuring credit of a buyer. Buyer lies and they provide fake accounts. And as insurer, you cannot go back and say, "Oh, it was a fraud." You take a risk. You provide the cover. You are standing by. It's not a defense in insurance for the buyer to, for example, do something wrong. You insure the risk. So I think, and again, on surety bonds, there are tons of issues when there is an issue of all the different type with the performance of, for example, the contractor. So it is not unusual in insurance. It just didn't develop that much into the ecosystem of trade finance, receivables, things like it. And to me, that's one of the areas that will change it a lot. Because look at every case that we've seen recently. Green Seal, first brands, most of the cases, there is something related to a supplier performance when it was either fraud or some type of other issues. And again, to me, it's a market. To me, it's a market that is not fulfilled today.
Mm,
And I don't see any reason why, for example, insurers need to fight a cutthroat battle for example, ensuring the credit risk of a buyer and don't want to go to a less competitive market of insurance supply. You can do, a better margin and all the different things. And again, you need to get tools, but that's what due diligence people are doing. We do this thing, for example, in our business, we do it for finances. If an insurer is coming and they're saying we want to design a product and we want to get insight, there are multiple providers who are able to help. There is also technology that is able to help.
mm,
So in this case, that to me will be a missing component that we don't have much now.
mm. Okay, that'd be interesting. So I think we have an insurer on your panel. So this could be a very interesting discussion.
Sure.
And so basically, you think it's underutilized, and more could be made of insurance in these structures.
Yeah, in my view, insurance industry generally is a little bit narrow-minded. I'm not saying about credit insurance, I'm saying insurance overall,
Okay.
because there are various parts that they done analogies in other places. Not that it's fundamentally against what insurers are doing; they're doing it for other type of products.
Mm.
So, in my view, there is tons of room for insurers to be more proactive in this industry and use it as opportunity.
Yeah, I can see this is going to be a very interesting discussion. Your panel, Igor, in a couple of weeks. So we'll very much look forward to that. And just to remind everybody, Igor will be speaking at our Alternative and Receivables Finance Forum, which will take place on the 26th of November at the offices of Clifford Chance in Canary Wharf, London. And yeah, we'll look forward to a continued discussion and debate on this topic, Igor, with your fellow panelists. So thank you very much for your insights of today.
Thank you, Michael, and I'm looking forward for the panel.
Thank you.